this second video, we will be mainly dealing with the possible consequences of the unfortunate events in the Ukraine. And with me for the second video is Fred Versteeg, known to many of you as an accounting expert from our Department of Professional Practice, our technical department. Can you say something to our viewers on what you've already seen on this in those full year financial statements?
Yes, I can. Well, obviously, for some of the companies, they already published their financial statements before the outbreak of the war. So those companies obviously didn't disclose anything. But many companies were still in the process of finalizing their financial statements. And then we need to consider whether any consequences or any effects of the outbreak of the war, and then it's particularly the financial consequences, obviously, would be the so-called non-adjusting or adjusting events. And typically, as the outbreak of the war is a new event, this is what we call a so-called non-adjusting event. So that means that any direct or indirect consequences didn't affect the numbers of the financial statements. But those companies really needed to look at whether it will have impacted them after year end, and then obviously needed to disclose any effects as a post-balance sheet event in these financial statements. And actually we have seen many companies doing so. However, if we look at the upcoming interim season, so that's really looking at the 30th of June interim financial reporting period, then these are adjusting events, or these are the events within the reporting period itself. So obviously, if there are any indirect or direct consequences for the company is involved, it will affect the numbers, it will affect the balance sheet, and it will affect the profit and loss. So that is surely what we expect to see to happen.
Right. Okay. Yep. Clear. So you mentioned direct and indirect consequences of this, Fred. Can you elaborate a little bit more what you mean by that?
Yeah. I think generically, I think it's always difficult to make a clear distinction between direct and indirect. But we have seen companies, or there are companies that typically have direct exposure in Russia and Ukraine. That almost every material item in the financial statements will be affected or can be affected. So look at the balance sheet, for instance. I think we really need to look at the recognition and measurement of those items, and to see whether that is still okay. But we also have seen presentation issues, for instance. So it's really about recognition and measurement and presentation, I think.
Right. And when you talk about recognition and measurement, can you be a bit more specific? What are we talking about?
Yeah, it may sound a bit abstract, obviously. But if you look at the recognition and measurement, and particularly looking at the debit side of the balance sheet, for instance, this is really all about, I think, about the valuation question and impairment question. Do the assets still have the economic value, or at least is the economic value more or less the same as the carrying value, or at least not lower? And that's what we're really looking at. And again, those buildings may have been destroyed. Those buildings may not be used anymore. Inventories may be lost. Those types of things may impact the valuation. And looking at IFRS, I think for instance, if you look at IS2, it has detailed guidance on impairment testing for inventories, obviously. We've IFRS 9, which deals with financial instruments, has detailed guidance on credit losses or expected credit losses to account for on financial instruments, obviously. And then we obviously also have the generic IS36, which is the generic standard on impairment testing, which may be relevant to apply for the upcoming 30th of June interim financial reporting. But that's on the debit side. Looking at the credit side, it may not be too obvious, but we believe that many more provisions may be applicable on that need to be recognized. For instance, due to the lack of business, reorganizations may occur or may take place. So that may warrant for additional recognition of a reorganization provision. Or, as already mentioned, sales contracts or purchase contracts may have become onerous, and therefore an onerous contract provision may be necessary in that respect.
Yeah. So it's clear the impact on the numbers could be very significant depending on the situation. Is there anything else, further consequences to consider?
Yeah, I don't want to be too pessimistic, but I think the list is endless. For instance, hedge accounting, which is a very detailed topic within the financial instruments, but hedge accounting may not be applicable anymore due to changes in purchase contracts or sales contracts, for instance. You may even need to consider where you still control Russian or Ukraine subsidiaries due to the situation over there. And even some companies need to look at their going concern assumption, for instance.
Right.
So the situation may impact their financial situation in a particular way, such that at least they need to look at whether they have a trigger that needs to warrants an additional assessment of their going concern assumption.
Right. You also mentioned presentation issues, Fred. Could you tell a little bit more about that?
Yeah, I think we have seen companies especially companies that have a subsidiary in Russia, for instance, that are looking for ways to leave Russia, basically. So looking for ways to sell off their Russian subsidiary. So then looking at IFRS 5, for instance, which talks about assets held for sale, non-current assets held for sale. Those companies typically will need to consider where they are in their plans and what that effectively means for the presentation of those assets. It may even be that that part of the business would qualify as a so-called discontinued operation. So also need to take into account the presentation of any income that's connected with that subsidiary or that business that also needs to be presented separately in the income statement. But there may be other consequences. For instance, restricted cash. If cash in Russia is not available anymore or you cannot really access that cash, you may need to think or may need to consider credit side once again, and also looking at liabilities. They may have become current instead of non-current. So a change of presentation in that respect as well.
Okay, so that's a lot about the direct consequences. How do you see the indirect consequences, Fred?
Yeah, and then I think, as mentioned, I think almost every entity will be affected by the indirect consequences. And I think everything I've just said and just mentioned is also pretty much applicable for those companies. But I think it will be even harder for those companies to really identify and really to assess what the consequences are. So these companies need to be really on the top of the game and really make sure that they look at their business model, look at all the risks that they encounter based on the new situation and try to see what that effectively would mean for their assessment, so impairment assessment, etc., etc. So that's going to be really challenging. And just to mention one example, I think, of indirect consequences, we just recently saw the large bank publishing their Q1 results, and you already seen that they increased their expected credit loss provision on financial instruments, their outstanding loans, obviously. And as people probably are aware, the expected credit loss also takes into account the generic economic situation we're in today. So already taken into account the indirect consequences.
So Fred, these financial statements that companies are publishing by 30 June, those will mostly be the interim financial statements, right? Yep. So in general, they will be less comprehensive than the full year financial statements.
Yep, agree.
What do you expect companies will need to do? Do they need to change anything in that respect?
Well, they still obviously are going to publish that condensed set. But I think we must be aware that IAS 34 talks about limited disclosure, for instance. But I think two major topics I would like to raise is, well, firstly, the accounting is the same. So if I account for any item on the balance sheet, I still apply the same accounting policies as I've applied during year end. So that's obviously is going to be relevant. So if there is an impairment trigger, companies will need to perform an impairment test, and therefore may need to record any impairment that is applicable. So that's one. And secondly, well, obviously it's a condensed set with limited disclosures, but the disclosures needs to be extended once a certain situation applies. So for instance, again, looking at that same impairment, if the impairment is applicable, then obviously all the disclosure requirements that are applicable under IAS 36, obviously, well, all of a sudden come into play and needs to be taken into account in the IAS 34 interim financial statements as well.
Okay, thank you, Fred, for your insights, very helpful. And I think it's good to know for the viewers that we have a very extensive website dealing also with a lot of the issues that Fred just mentioned here. It's called Accounting in Uncertain Times, and you can find it on our website. So this concludes the second video. Thank you for tuning in, and we will move to the next video, number 3. Thank you.